What's up, tycoons? What's up, traders? Super excited for today's video. As always, the content provided on this channel is for informational and educational purposes only. It is not intended to be relied upon as legal, financial, or investment advice, so please be sure to read through the full disclaimer. Now, what I want to start off here is volatility is the toll we pay to invest. And what we're going to do in today's video is actually break down some of the statistics, some of the economic data, and some of the things really driving the market right now that I think is very important for you guys to pay attention to. I value my time a lot and I value your time, and I'm not going to try and waste either one of our times. I've dropped a lot of technical analysis videos here recently without these types of data behind them, and now we're going to get back into some of these data driven videos. So the market recently, and when I say the market, speaking of the S&P 500, it recently pulled back about 6%. Now, you can see that a 3% dip is the most common, right? And a 5% dip is going to be right after there. So that's what we recently experienced, right? We recently got over a 5% mild correction in the market, and things were very frothy, okay? There's no secret, things were very frothy. Everything seemed to be going up. We saw short squeezes. We saw bankrupt companies going up hundreds of percent. And now we've gotten that pullback, and Nvidia just reported earnings, and it's very possible. Okay, it's not a guarantee, but it's very possible that after getting our 5 to 6% correction, we could actually be due for the next leg up in the market. Okay, now seasonality wise, August normally isn't the best month in the beginning. We went over that. As soon as September starts, I'm going to show you guys the September seasonality. It's very possible we get another pullback, towards the 10th to 20th of September in the market. So be on the lookout for that. But what I really want to highlight is, basically the chances of getting a 10% to a 20% correction, those are very, very slim, right? I mean, when you look at a 15% severe correction, that happens every 1.5 years, and then a 20% bear market, that happens every 2.7 years. So, being that we just entered a new bull market, the likelihood of us dropping another 15% or 20% is not that high, right? But, just because we've experienced this, over 5% mild correction, that's very normal, right? And that's what the whole purpose of this is that volatility is the toll that we pay to invest. So it's never going to be smooth sailing going up. Maybe right when you buy, it gets that 3% dip, or, it always feels like after you buy, it gets that 5% dip right afterwards. And that can be frustrating, but, you have to keep an open mind to things and really let the numbers speak for themselves. Now, this data set that we have right here, this is actually once you exit a bear market, okay? And so you can see here, and take a look at the performance 1 week out, 2 weeks out, 3 weeks out, 1 month, 3 month, and 6 months. And so, as we move forward, and since we've, technically, right, from a technical analysis standpoint, we've rallied more than 20%. In the S&P 500, so that got us out of the bear market, and we started technically a new bull market. All right. What I really want to highlight is the data set surrounding 3 months out after. Okay. 3 months out after and 6 months out after. Okay. These numbers look pretty good, and this is enticing for basically the end of the year, right? To finish off 2023 and heading into early 2024. The numbers look pretty enticing here, right? We can see that a large majority of these are positive returns. There's many double-digit returns with 23%, 43%, 11.6, 15%, and 6 months out, it gets even more impressive, right? When you look at some of the returns right now, there is about 2 more red years in this data set, 6 months out. And then a year out, it gets a little bit more volatile, right? It's a little harder to tell, but that's if you're using all of the data sets, right? And what I mean by that is I think we can all agree that the economy and the U.S. market has really shifted since the 40s, right? And since even the 1930s. So if we were to just draw a line here, and what I mean by that, and what I'm telling you guys by that is technology, right? The big technology boom. And right now we're going through an AI boom. But, originally America had the Industrial Revolution, and that was a very big deal. And now, the technological revolution has really changed a lot of things. But when you take out the data sets from the 40s and you just look below there, you can see that 1 year out, okay, the returns are very impressive. Okay, if you go from, you know, essentially past 1940 to the present, there's only 2 times where a year out after exiting a bear market, that the market has been red, and that was in 2001. We all know about the dot-com bubble, dot-com crash. Okay, and then the other one was in 1948. So, you know, I just think that that's some noteworthy data for you guys to, you know, pay attention to, screenshot, keep in the back of your head. Now, I do want to mention I started a completely free newsletter. Right, there is a website associated with it too, so you can actually go back and read all of the old newsletter slash posts. This is what the website looks like. You know, so the articles on there and the posts. This is what it's going to look like. Right, coming straight to your inbox. I'm going to have some nice written up stuff for you guys. There's going to be some charts involved too. And there's different trade ideas, right? Most notably here recently, we had TJ Maxx, TJX. We had the gap up and it was looking like a breakaway gap. Now, originally we had this trend line. I've so far taken this trend line off my chart and actually drawn a more of a pennant than a flag here. And you can see either way, we broke out past this trend line and we broke out past this trend line today. If we can keep this momentum up, it's very possible TJ Maxx hits some of our bullish price targets to the upside. You know, that was a recent, you know, trade idea. Okay, this is SWK, Stanley Black and Decker. This trade worked out magnificently. There was a rising wedge. We were looking for the breakdown. You can see we came down and hit the third price target here at 88.68. We're starting to consolidate. We got that little bit of a bounce up that we're expecting, right? Move down, then a bounce up, move down, bounce up, right? And that's what this arrow is, just kind of a guideline telling you guys what you can expect. So this was another really good trade from the newsletter. Again, a completely free newsletter. This is Tesla right here on the daily time frame. We had an abandoned baby chart pattern. We talked about, you know, look for the breakout here, look for it to hold above its 5-day moving average, and look for it to hold above 233.34. That's exactly where it closed yesterday, right? And then we opened below today, but we saw a strong push up. So we've been able to hold above 233.34. Real quick, I do want to explain that that's a kind of a common misconception that people have. You know, everything's very relative to your time frame, right? So if I'm showing you guys a daily time frame chart, and we're saying, hey, maybe you want to get in this if it can hold above 233, and you're selling when it dips down below here and then it comes back up and closes at that level, then, you know, you're not managing the play correctly, right? And over here, when it opens below, the day is not over, right? It hasn't even closed yet, right? So now we're actually pushing up higher. Okay, and we're actually closing above the level, so we're maintaining and holding above the level, right? That's a common misconception that people have, and where people, you know, they'll get stopped out of a play, right? Like, let's say they sold here and then they see it rally up and now they're frustrated and say, you know, trading doesn't work and things like that. You know, just a common misconception. So you know, we'll move on from that. There's a link in the description, comment section down below. Sign up completely free, straight to your inbox, and it'll help support the channel out. Now, what we're looking at here is the evolution of the Atlanta Fed GDP now, real GDP estimate for 2023 Q3. And this is really spectacular, right? I mean, if this is accurate, you know, we're looking heading up towards 6. You know, this is definitely not what people were expecting, right? When you take a look at the range of the top 10 and bottom 10 average forecast, the Atlanta Fed GDP now actually has us much higher than that. And so there's 2 ways to look at this, right? And in today's video, we're going to kind of slant more on the bullish side of things. Okay, I've dropped some bearish videos and dropped, you know, the bearish data sets out there and the bearish arguments. Now we're going to kind of go over the bullish arguments, right? We looked at some of the historical data after exiting the bull market. Okay, if the economy is doing well, and, you know, whether you like it or not, I know prices are still high. That's not how inflation works, right? Prices are still going to be high. They're not going to go back down. That's actually bad for the economy. That's called you know, deflation. What we're looking for is disinflation, and I kind of wrote about that actually recently in a newsletter, and, you know, you can go back and read that post. But, you know, we're not looking for the prices of everything to start completely tanking, right? We're just looking for them to start going up, you know, at a slower speed, right? We don't want to see them increasing 9% year over year like we saw last year. And when you take a look at the non-financial corporate net interest costs, they're at 60 years low. So corporate net interest payments as a percentage of after-tax NIPA profits. And then you take a look at the Fed funds rate right here. This is something that is, what I think is pretty relevant. Okay. Now this could be considered a little bit of a bearish argument. The reason being is because you see that these tend to have a little bit of a lag, right? So notice how the Fed funds rate starts pumping up here, and then corporate interest rates start to pump up afterwards. It's very possible that that can happen, but these two tend to stay correlated with each other pretty well. And the reason that we're seeing this massive divergence is because of this right here, 2020. That shaded area right there is a recession. That's 2020. And what corporations did was actually really smart. They took out more debt than they needed. They took out massive amounts of debt because you could basically take out money for free. Okay, it was zero interest rate environment. When you take a look at the Fed funds rate, zero interest rate environment, and the pandemic scared a lot of people, and so corporations were actually really smart, and what they did was they locked in a bunch, and when I say a bunch, I mean tons and more than they needed of loans and funding, and taking advantage of that low interest rate environment. And now that we're in this high interest rate environment, it's not really affecting too many of the corporations yet. It may affect them in the future, but as of now, they're still locked in on their really cheap interest payments. So that's kind of bullish. When you take a look at inflation expectations, this is the net percentage of the fund manager survey investors expecting higher inflation. This is from Bank of America, their Bank of America's global fund manager survey. And look how low it is right now. So, again, you could look at this and be a contrarian and say, oh, well, last time we reached these levels, it was, in 08, 09, and then that skyrocketed up. But overall, the way to read this is that fund managers, they're really not expecting higher global CPI. And there's a number of reasons for that. If we dive forward a little bit, OER, this stands for owner's equivalent rent. This is pretty much all that is holding the CPI up. Now, I have dropped some videos and I've talked about it before in the Discord as well, and highlighted how the period of really good inflation reports, in my opinion, is kind of ending right now. And the reason is because we've already passed peak inflation on the year-over-year CPI reports. So now each inflation report that we're comparing on a year-over-year basis from last year is actually lower, right? So when it kept going up higher, last year, and we're comparing a year later and inflation has started to fall a little bit, it's easier to beat those numbers. But now we're going to be competing with those. We saw the price of oil and energy stocks, really skyrocket all throughout June and half of August. So, that could show up in September on the next CPI report. So if that's the case, then, it's not just OER, but for the sake of presentation, this is from Charles Schwab, all right, and the U.S. Bureau of Labor Statistics, and this is via August 10th, and really just showing you that owner's equivalent rent is pretty much all that is holding the CPI up. Therefore, if housing declines, as many expect, CPI is going to crater. Now, what's one reason that housing would decline? Well, because Treasury yields have been skyrocketing, right? Your average 30-year mortgage rate is almost at 8%. Okay, I know mortgage brokers, and they're telling me how it's crickets. They've never been so slow. Don't know what to do with their time. And even some of them are picking up trading, and trying to trade pretty much the whole day because they don't have anything to do. But what we're looking at is everything else in yellow, and then we're looking at housing. Okay, basically this owner equivalence rent here in blue. And you can see that this has continued to stay up and stay elevated while everything else has continued to decline. Now, this is that time period here where I was telling you guys we had that peak inflation. And now, we're coming up into September, and we're going to be comparing on a year-over-year basis of, inflation that already started to fall. All right. So another kind of just visualization of that. Now, this is a trailing 12-month headline inflation with alternative shelter metrics. And this is from Wisdom Tree. Okay. Shout out to them. I know they just made an appearance on the compound here recently. I think that may even be where I got this from. But this is just a little bit more of, taking into account of, if you get rid of the owner's equivalent rent, which, is not the best metric, especially to be including in the CPI, then, it appears that, inflation could actually be much lower than it actually seems right now, and a lot closer to that 2% Fed target rate. Now, another thing that people have been screaming about, and it's something that I'm going to cover in a video here soon, but there's a lot of misconceptions. Oh my gosh, credit card debt just hit a record 1 trillion, right? And I think it's hit 1 trillion before, and that was right around the great financial crisis. What people don't realize is how much inflation have we experienced since 08, 09, right? We've seen massive amounts of inflation. Okay. So, not only that, but how much more, money are you making as a person, right? Your average income is making much more money than they were in 08, 09. Everything is much more expensive. And so if everyone's making more money and everything is more expensive, shouldn't credit card debt be able to pass, and be far above $1 trillion? And so when you take a look at it, credit card debt is just 6% of the money people have in the bank, around the lowest percentage in 20 years. So people are hollering and screaming like, we even had people in the Discord talking about this, and I said, hey, while that may seem, crazy, just think about it, right? I mean, that's the last time it was at those levels was 08, 09. And I just explained to them kind of what I'm explaining to you guys right now. And this is just a visualization of that, right? You can see it's still very, very low. And these were the levels that it was at in 08, 09, is up towards 10%. So we're still seeing very, very low numbers right now. Now, I mean, has it been on an uptrend? And is this something to, pay attention to and be concerned about? Yes. But I mean, if we were just to even try to do some technical analysis on this, okay, there's resistance up here just above 6%, right? So this thing could climb up towards 6%, and get to 6.1, 6.2. Is that the end of the world? No, not really. Now, if it breaks past there and it starts heading back up to 10%, then that's when we're going to see some issues. And now think of the percentage gain that would be. If we're roughly at 6 right now and we go up to 10, okay, that's 4 over 6. That's a 66% increase of the debt level we're at right now. So if we're at 1 trillion, that's 1.6 trillion. Okay, it's a much bigger difference, and that is maybe something to be a little bit more concerned about. So there are some misconceptions about this, and economists and investors and strategists and market makers and hedge fund managers, this is how they're looking at the data, right? And they're kind of looking at it the way that I'm explaining it to you guys. They're not looking at it as just the headlines and saying, oh, record 1 trillion. They're taking into account all of these other factors. Now this is also credit card delinquency by the zip code income. And so what you're really seeing is, very low levels. Okay. This is the top income centile up here. Okay. So the higher, and you can see that, and this is the percentage of credit card balance transition to delinquency. You can see it's very low, right? So this is the 2023 period right here. It's not really anything to be concerned about, and it's on the lower end of the income centile right here. All right. Now, bond funds have actually started seeing record inflows. Now, it may be hard to tell because of some of the price action, and largely that's due to treasury yields rising. So it doesn't matter if that the bond funds are getting inflows. If the yields are going higher, then the bond funds and ETFs are going to go lower. It's just that simple. And I'm honestly really attracted to bonds. I'm in my 20s. I'm pretty young, so as a trader or investor, it hasn't really been that time period where bonds have really even been attractive, right? The yields have been so low that they haven't been attractive, and now we're not seeing that, right? I mean, treasury yields are extremely high right now. So not only do you have the opportunity to take advantage of holding treasuries to maturity and letting them hit maturity, but there's also trading opportunities available here, right? If you're someone that thinks that the Fed is going to cut interest rates in 2024, then that potentially would lead to some of these bond ETFs actually going up in price. Remember the concept of how bonds work. As the yields go higher, the price goes lower. As the yield goes lower, price goes higher. And so there is that chance that, if the Fed starts to cut the federal funds rate, that you may actually start to see, treasury yields start to actually fall back down, which would result in bond ETFs, prices going up. Now, there's no guarantees in any of that. Okay. And the Fed doesn't have to cut rates. And maybe if they cut rates, it's very possible that treasury yields can still stay elevated. But that's something to keep in mind. Now, we'll go ahead and move forward. We'll talk about discretionary positioning has now recorrected with the rates volatility. So this is the move index. All right. So this is your bond market volatility. All right. And then we have discretionary investors equity positioning right now. And you can see that oftentimes these two trade in pairs, but sometimes the discretionary investors equity positioning gets a little bit too elevated, right? Now, this is a correlation since 2021, and it's they're basically correlated with each other about 81%, 89% of the time, meaning that about 11% of the time there's these divergences, right? There's a divergence here where this is going up and it's going down. You can see the divergences here where it's going down, it's going up. So there's often times where there's these divergences, but this is just something interesting that I thought, I recently talked about the move index. It's basically the bond market VIX in a recent video. So I thought I'd go ahead and include this. And now we're reaching back to this point of equilibrium here, okay, where we're seeing the move index and discretionary investors equity positioning start to align back together. Now, this may look like a bunch of mumbo jumbo, but what we have right here is the McClellan oscillator. And this is stuff that I'm actually considering like putting more of in my videos and maybe even my newsletters. A lot of these more institutional, oscillators and indicators, and, just types of things that not your average investor looks at besides the RSI. I normally try to keep my videos pretty simple with like a RSI and a MACD. But there's a wide range of complex data sets and study sets that you guys can use that are actually, a little bit more insightful. And essentially what we're seeing is, once we come down to this negative 100 area, this is the S&P 500 below it, you see that we start to rally afterwards, right? Over here, we come down to that area, we start to rally. Over here, we come down to that area, start to rally. Now, I'm not drawing perfect lines down, so it doesn't match up perfectly. But, each time we come down, below this negative 100 area, we start to see rallies in the market. And here recently, we did that, and the market has rallied for about 2 or 3 days in a row now. So this is just some stuff that, I'm looking at and I'm saying, okay, well, I'm not going overly bearish at this time. I'm not going to go all in on put options on the S&P 500, whenever you're seeing indicators like this, coming across in the market. Now, that's it for today's video. Appreciate you guys watching. Don't forget, I got that completely free newsletter, right? You can get it straight into your inbox. I'm sending out multiple newsletters every single week. And, many of them are going to have trade ideas in there. Not every single one, because I don't want it to be just solely focused around trading. I also try to provide value. It's called investment intelligence. So I try to provide investment intelligence through that newsletter. Of course, it's not personalized financial advice, but rather just some basics and, some good information that I like to spread with you guys. And I think that it's great content. And if you're a fan of free, valuable content that, you can benefit from, as well as free trade ideas and setups, I definitely think you're going to enjoy it. Feel free to share it with your friends and family or anybody that you think would enjoy it as well.